Stop. Don't touch your SLV position yet. Don't buy the dip. Don't hit sell out of fear. Don't even open another chart until you understand what just happened. Because during this crash, SLV did something it's not supposed to do. It briefly detached from the value of the silver it claims to represent. Not by a little, by a terrifying amount. Between the January 29th peak and the February 17th low, silver got hit hard. And on February 1st, right after the London benchmark settlement, SLV reportedly traded at nearly a 20% discount to its own net asset value. That means the ETF price was materially below the value of the silver the trust said it held. That is not normal volatility. That is the market screaming that the plumbing can seize up when the room catches fire. So here's the promise you were sold, and the reality you need to hear before the next wave. Welcome back. We're going to move fast. No fluff, no maybe someday. Just the structure, the crash data points, and the exact signals you should be watching over the next 8 days. If this kind of breakdown saves you from one bad decision in a chaotic market, subscribe. Simple. And I want one thing from you in the comments. Did you hold SLV through the crash or did you exit? And if you held, was it conviction or did you just freeze? Quick disclaimer, educational analysis only, not financial advice. I'm not your advisor. Talk to qualified professionals before making decisions. Now, let's talk about what SLV actually is, because most holders think they own silver, when what they really own is a mechanism. SLV is the iShares Silver Trust. It's the largest silver investment vehicle in the world. The trust reports roughly 580 million ounces of silver and around $12+ billion in assets depending on price. The idea is simple. Each share represents a fraction of a troy ounce, often cited around 0.925 troy ounces per share, and the share price is designed to track spot silver. The marketing is clean. Easy exposure, no storage, liquid, tracks spot. And for most of its history, it has tracked spot closely enough that people stopped asking questions. That's how these products get you. They work perfectly, until the moment you need them to work perfectly. Here's the first reality that changes everything. If you're retail, you cannot redeem SLV for physical silver. You can't take your shares and ask for bars. You can only sell the shares on the market to someone else. Only a small group of institutions called authorized participants, big banks and broker-dealers, can create or redeem SLV shares directly with the trust. And they do it in large blocks, commonly 50,000 shares or more. So the physical backing mechanism is real, but it is not available to you. You don't own a bar. You own price exposure delivered through institutional pipes. In calm markets, that distinction feels academic. In stress, it becomes the entire story. Now we get to the crash moment that should keep you alert. On February 1st, SLV reportedly printed close to a 20% discount to NAV after the LBMA benchmark settlement. Think about what that implies. In theory, a huge discount should be instantly arbitraged away. Institutions buy discounted shares, redeem for silver, sell the silver, pocket the spread, and the discount collapses. So why would a double-digit discount even appear? Because something in the arbitrage chain can get delayed, constrained, or priced as risky. And when the market starts pricing risk inside the wrapper, you're no longer trading silver. You're trading confidence in the wrapper. Let's anchor where things were described as of February 18th in the script you provided. Silver was around $77–78 after bouncing off a crash low near $72.44. The point isn't the exact tick. The point is that $5 swings are now normal, and the next 8 days can decide whether this becomes a clean rebound or a second panic. Here's the trap. A lot of investors look today and say, but SLV is back near NAV, so everything is fine. That is surface-level thinking, because the crash exposed 3 structural differences that can matter massively in the next pressure window, especially into February 24th through February 27th. Difference 1. What happens when SLV needs physical silver, and physical silver is hard to source? In normal conditions, when new SLV shares are created to meet demand, the trust acquires physical allocated silver bars and holds them in custody. That's the backbone of the product's credibility. But in tight physical environments, there's a temptation in the system to rely on unallocated exposure, bank IOUs, rather than immediately sourcing specific allocated bars. Allocated means specific bars with serial numbers held for the trust. Unallocated means a claim on a pool, a promise that metal is available in the system, not necessarily a specific bar tagged for the trust right now. And the script you provided referenced analysis claiming that, as sourcing got tougher in early 2026, SLV began accumulating some unallocated exposure, estimates like 3 to 5% by January 26th, potentially rising when inflows surge and bars are difficult to source. I'm not here to verify it. You told me not to. I'm here to make sure you understand the consequence if it's true. If even a small portion of the silver backing is unallocated, you have an extra layer of counterparty exposure. Your share is a claim. The trust holds a claim. The trust's claim can be an IOU. That's a claim on a claim. And when everyone wants bars at the same time, claims don't calm people down. Bars do. If you want a precedent for what stress looks like, the script pointed to March 2020 in gold. Unallocated exposure rising sharply, redemption and settlement delays stretching, emergency logistics to move metal between hubs. That was a temporary bottleneck. The scary part about silver in this narrative is that it isn't framed as temporary. It's framed as structural tightness after years of deficits. Again, not verifying, just explaining the logic. Temporary problems get solved. Structural problems create recurring stress. Difference 2. The authorized participant escape hatch only works when the exit door is actually open. People love the phrase, ETFs can't break because arbitrage fixes it. But arbitrage is not a magic spell. It's a process that requires settlement, sourcing, and delivery to run smoothly. Now look at the calendar pressure described in your script. February 27th is the first notice day for COMEX March silver contracts. That's the window when delivery pressure can jump. And if delivery demand is elevated across COMEX, London, and Asian physical venues at the same time, the system can clog. That's when you get the thing retail investors hate most, tracking error precisely when volatility is highest. So even if silver itself is stabilizing or rising, SLV can wobble relative to spot because the wrapper is being stress tested. Difference 3. Not all silver vehicles are built the same, and the crash made that obvious. Your script compared SLV to PSLV, Sprott Physical Silver Trust, which operates under a different model. The key claim: before PSLV issues new shares, it must have allocated physical silver already in custody at the Royal Canadian Mint. The model is described as fully allocated with identifiable bars, and redemption rights are structured differently, with a path for sufficiently large holders to request physical redemption more directly, not limited solely to authorized participants. What matters is not brand loyalty. What matters is structure, and the crash behavior highlighted it. According to the numbers in your script, while SLV briefly showed that extreme discount moment near 20% on February 1st, PSLV's discount widened but stayed more contained, around 5 to 6% at peak stress, then narrowed to about a 3.78% discount by February 18th, with NAV around 26.42 and market around 25.42. Here's why that comparison is such a big deal. A discount in a closed-end style trust can be normal. Market price can drift from NAV because shares trade on their own supply-demand dynamics. But an extreme discount in a product marketed as a tight tracker is supposed to be quickly neutralized by the creation-redemption mechanism. So when it isn't, even briefly, it raises the question: was the arbitrage chain impaired, or was the market pricing a wrapper risk it doesn't normally price? Now we need to talk about the uncomfortable part nobody likes to say out loud: custody optics. In the script you provided, SLV's silver is described as held in major bullion bank vaults in London, with a system where big banks are involved as custodian and as participants in the creation-redemption ecosystem. In calm times, that can be efficient. In stress, people start thinking about incentives. You don't need proof for incentives to move prices. You only need suspicion. And suspicion spreads faster than facts in a crash. Now, the big question every SLV holder is asking: should I sell SLV? I will not tell you what to do, and anyone who tells you what to do without knowing your full financial situation is doing you a disservice. What I will do is give you a clean framework, 3 scenarios for the next 8 days, and the signals that point to each. Scenario 1. Bullish and orderly. Shanghai reopens on Monday, February 24th, with strong physical buying. Silver pushes from the high 70s into the 80s and keeps climbing. The February 27 delivery window passes without visible strain. Physical sourcing looks normal. SLV tracks spot cleanly. NAV stays tight. In this world, SLV holders get what they came for: liquid exposure, and clean tracking. Scenario 2. Managed stress. Shanghai reopens with moderate demand. February 27 brings elevated delivery pressure, but the system handles it through inventory shuffling, conversions, and roll activity. SLV tracks most of the time, but during peak volatility, you may see temporary 5% to 10% NAV discounts appear, and then mean revert as conditions normalize. In this world, SLV doesn't fail, but it reminds you that liquidity comes with mechanism risk. Scenario 3. Acute stress. Shanghai reopens aggressively. February 27 delivery demand overwhelms registered inventory. Physical sourcing is strained simultaneously across COMEX, London, and ETF channels. Unallocated exposure rises. Authorized participants submit big redemption blocks for bars. The trust faces a sourcing crunch. Discounts widen into the teens, 15%, 20%, potentially 25%. In this world, you can be right on silver and still have your SLV position underperform spot because the wrapper is being repriced for settlement and sourcing risk. Nobody knows which scenario plays out with certainty. If someone sounds sure, they're selling certainty, not analysis. So instead of predictions, focus on what the market can't hide, the signals. Signal 1. SLV premium discount to NAV, daily. Don't only watch spot silver. Watch SLV relative to NAV. The script says around February 13th the NAV discount was roughly negative 0.51%, basically near par. If you see that gap widening toward 5%, 10%, 15% without a matching move in spot, that's your early warning. That's the market charging a wrapper risk premium. Signal 2. Reported holdings behavior. SLV publishes holdings data. Watch the ounces. If reported ounces fall sharply without an obvious redemption narrative, or if the numbers behave strangely during heavy inflows, you don't assume fraud. You assume stress. You assume the pipes are being forced. Signal 3. Any procedural or disclosure language changes. If you see changes around redemption terms, settlement timing, or disclosure language into the February 27 window, that's the kind of institutional signal retail usually notices last. Don't be last. Signal 4. The spread between SLV and alternative structures. Compare SLV to PSLV's discount behavior and to spot. If SLV begins trading at a worse discount than a fully allocated structure during the same market hour, that's a vote against SLV's wrapper, not against silver. Now let's get practical because theory doesn't pay your bills. You need to identify your true goal. If your goal is short-term trading exposure, quick entries, quick exits, low friction, SLV is built for that. Liquid, tight spreads, easy execution. But if your goal is long-term crisis exposure, you must face the contradiction. You're expressing a silver shortage thesis through a structure where retail cannot redeem, and where the arbitrage chain depends on institutions behaving smoothly during stress. That doesn't automatically make it bad. It makes it a different product than most holders think they bought. Here's the question that reveals your risk tolerance in one sentence. If silver spikes $10 overnight during a delivery crunch, are you okay with the possibility that SLV lags because the wrapper is repriced for stress? If your answer is no, then your problem isn't the silver price. Your problem is the vehicle. And this is why February 1st matters so much. Because the market now has a memory. Once traders see a product briefly detach from NAV by a huge margin, they never fully forget it. The next time volatility hits, people don't wait for it to happen. They front-run the possibility. And front-running the possibility is how a discount becomes self-fulfilling. Now, let's talk about what retail did during the crash. The script says retail investors kept buying the dip even after the plunge. That makes sense. Retail saw cheap silver exposure and hit buy. They weren't necessarily wrong about fundamentals. The narrative they're buying is, industrial demand is rising, supply is tight, delivery pressure is real, deficits are persistent. But SLV is not silver. SLV is a pathway. The crash didn't disprove the metal narrative. It exposed pathway risk. So your next move should be based on a simple self-audit. Are you holding SLV because it's the best expression of your thesis? Or because it's the easiest button to click? Be honest. Your brokerage app doesn't care about your thesis. It only cares about what you can execute. Now, I'm going to give you a clean mental model you can keep forever. Think of SLV like a highway that usually gets you to your destination quickly. In calm traffic, it's perfect. In a storm, it can jam. And when it jams, the car you're driving doesn't matter. you're stuck in the jam. Allocated metal exposure, whether through a structure described as fully allocated or through physical possession, is more like taking a back road. Slower, more friction, less convenience, but less dependent on a single choke point. Neither is right for everyone, but the crash just forced you to admit which road you're really on. One more detail people miss. Even if you own a lot of SLV, the rules don't bend for you. If you have 5 shares, you can't redeem. If you have 5,000 shares, you still can't redeem. Even if you have 49,999 shares, you still can't redeem. The door only opens for institutional scale blocks. Your exit is always the market, not a vault. And yes, SLV is popular for a reason. The fee is commonly cited around 0.50% a year. It's liquid. It's simple. You can move in and out in seconds. In normal times, that convenience is a feature. In abnormal times, it can become the risk, because the convenience assumes the plumbing stays smooth. That's why back near NAV today is not a victory lap. It's a snapshot. The question is, what happens on the next stress day? The February 1st discount event matters because it proves the system can glitch. And once a system proves it can glitch, the market starts demanding a bigger discount the moment pressure rises. Here's your checklist for today. Pull up SLV's published NAV and compare it to the trading price. Then pull up the reported ounces and note the number. Write it down. Do the same tomorrow. If the NAV gap widens while spot is stable, you're watching wrapper risk in real time. If the ounces shift in ways that don't match the flow narrative, you're watching stress. And if the spread between SLV and alternative structures moves violently, you're watching confidence move. That's the edge. Stop reacting to headlines and start reading the pipes. Now, before we wrap, I want to set one cliffhanger, because it's the part most people are not watching closely enough. February 24th is not just another Monday. It's a reset point. It's the moment the physical market re-engages after a crash period, and it happens days before a known delivery window on February 27th. That combination is exactly where systems get stressed. Fresh demand meets tight settlement timing. So here's what I want you to do with this video. Don't make a decision based on fear. Make it based on structure. Watch the NAV gap. Watch the holdings. Watch the language. Watch the spread versus alternative structures. And ask yourself one final question, and answer it in the comments so you commit to a plan. Are you holding SLV because you want silver's upside, or because you want silver's certainty? Because those are not the same thing. If this gave you clarity, hit like so more people see it before the February 24th reopen window. Subscribe if you want the next breakdown, where we go deeper on the alternative structures and what fully allocated really means in practice. And comment with your move. Held SLV, rotated, or waiting for confirmation, and what signal would make you change your mind.